Financial backers of Tesla have had a very difficult few weeks. Many have sold their shares out of concern that the stock price will continue to decline, while others are still undecided about whether to sell or hold onto their shares in the hopes that future Tesla stock prices will improve. Morgan Stanley claims that Musk's ongoing Twitter drama has hurt Tesla's stock price and may put the EV manufacturer at further risk in the future. Welcome back to All That Tesla Stock, everyone. Over the last few weeks, Tesla stock has seen a number of notable declines. The stock price has been declining, but it has increased a few times in recent weeks. A number of variables pose a serious threat to Tesla stock and the firm itself, even though there are several catalysts that have the potential to cause the stock price to soar. Here are 3 things that could stop Tesla stock from increasing in the future. Before we begin, though, please remember to hit the like button, subscribe, and enable notifications if you enjoy this type of content, so that you can be informed on everything Tesla. First, possible Chinese lockdown. China, the second largest economy in the world, has seen a rise in protests against harsh and severe economic restrictions. And these protests are adding to the uncertainty and instability in the global economy. This occurs while nations are attempting to recover from high inflation, an energy crisis, and the conflict in Ukraine. As of October 24th, China reported more than 1,000 cases of the virus for the 3rd day in a row. Around 107 million people were impacted in areas that accounted for nearly a fourth of China's GDP, with exactly 28 cities nationwide implementing some form of lockdown. Approximately 100 lockdowns have been imposed nationwide recently, with the majority of these impacting communities classified as high or medium risk. China has been the world's factory and a major force behind global expansion for many years. Thus, any significant setback there will unavoidably have an impact elsewhere. More turbulence, according to analysts, might further slow down the nation's output and lead businesses in the US and Europe to distance themselves from China and diversify their supply chains faster in response to the pandemic's lessons. The Shanghai shutdown, which was accompanied by closures in other cities, had a major negative impact on Tesla and the Chinese auto industry as a whole, reducing car sales by more than a third when compared to a year earlier. However, while the automaker's Chinese rivals also displayed evidence of a larger market decline, their drops in deliveries and sales growth were smaller than Tesla's 18% dip. This is probably due to the fact that these businesses operate production facilities in cities that were not entirely under lockdown. With its primary manufacturing facility in Anhui Province on China's east coast and its headquarters in Shanghai, NIO may have been spared the harshest consequences of the lockdown thanks to its production facilities outside of Shanghai. Just before the epidemic began in January 2020, Tesla delivered its first cars built in China to local consumers after opening its Gigafactory in Shanghai in 2019. But it wasn't until 2021 that the business started supplying a second China model. Domestically, Tesla is mostly dependent on the Chinese market. In June, the carmaker said that deliveries fell by 18% in the second quarter compared to the first 3 months of the year, marking the first quarterly sales loss in years. Tesla claims that a significant factor in the drop was the severe, protracted, month-long regulations in Shanghai that compelled the business to close its local Gigafactory and halt manufacturing. Its delivery and production levels were significantly impacted by this action. BYD, Tesla's largest rival, was one of the major Chinese EV manufacturers to announce quarterly growth at this time. The company recorded total sales of 355,021 units in the second quarter, up 21% from 191,378 in the first quarter. But the explanation for this is not implausible. Although both Tesla and BYD are in the same industry, BYD offers hybrid cars in addition to commercial vehicles like buses, whereas Tesla exclusively sells pure-play electric passenger cars. China is now the largest EV market in the world thanks to Tesla's continuing production ramp-up there, which has seen the company sell over 1 million units as of 2021. China accounted for about 66% of all EV sales worldwide. Tesla sold about half as many cars in China as it does in the United States, approximately 48.5% of the totaled $6.41 billion in U.S. sales during the same period were made in China, where the corporation reported $3.11 billion in revenues in the second quarter. Additionally, Tesla recently broke its monthly record in September by delivering 83,135 EVs manufactured in China. This figure set a global record for Tesla's Shanghai factory since production started in December 2019 and represented an 8% increase over deliveries in August. Tesla continues to invest in production in China since it is the largest auto market in the world and a key target for international companies. However, a new lockout might cause manufacturing to be disrupted, which would eventually affect profitability. The second risk is that Musk might sell more Tesla stock. Musk's potential to sell more shares is currently a significant risk to Tesla's price. In 2021, when the company's stock jumped more than 50%, the CEO of Tesla sold around $22 billion worth of Tesla stock. Similarly, earlier this year, Musk sold over $8 billion worth of stock in April and roughly $7 billion in August. Musk informed supporters that he had finished selling Tesla stock to pay for his Twitter takeover agreement. When they inquired about the prospect of selling additional shares in a tweet, he said that he had sold the shares to raise money in case Twitter compelled the deal to close and some equity partners didn't follow through, in which case a fire sale of stock would have to be avoided. This occurred when Musk was still attempting to back out of the arrangement by suing the social media business. In the end, the CEO of Tesla bought Twitter and raised money for the project by selling more Tesla stock days after purchasing Twitter. For over $44 billion, Musk sold almost $3.95 billion worth of Tesla stock. According to U.S. regulatory documents, SEC data shows that the now Twitter president sold 19.5 million Tesla shares. Since Musk's April bid for Twitter, Tesla has lost almost half of its market value, and several experts have not held back in expressing their disapproval of the transaction. Furthermore, there is no assurance that he won't sell shares in the future. Third, persistent macroeconomic situations. Tesla's supply chain outperforms the majority of its rivals, and as the firm increases production, several analysts predict good success in the upcoming years. Despite the economic setbacks brought on by the pandemic, the carmaker reported amazing quarterly earnings. Elon Musk, the CEO of the firm, stated in July that all of the Model Es and Model 3 South that buyers desired were already in stock, indicating that the company's issues were with manufacturing and logistics rather than client demand. Even while Tesla appears to be managing the challenging economic climate effectively, things could be about to change. Early warning signals of pressure are emerging for the most valuable carmaker in the world, especially as its premium pricing is subject to a weakening global economy and declining global auto sales projections. The Federal Reserve is also anticipated to continue raising interest rates to battle inflation. The central bank is currently implementing the most aggressive rate hikes for decades, despite having previously lowered rates during the pandemic. With a recent 0.75 point interest rate hike, the U.S. Central Bank formally lifted benchmark rates to their highest level since mid-2008, with a target range of 3.75% to 4%. According to the Fed, interest rate increases will probably continue until there are indications of